Good day, ladies and gentlemen. In this video, I'm going to be teaching you a forex trading strategy that you can use to make money in the forex market. Okay, so this strategy is very simple. All you need for this strategy is an FVG. Okay, you need a fair value gap. This is more like a swing trading opportunity because, as you can see up here, I'm on the 4-hour time frame on Euro card. Okay, so if you want to use this opportunity, this strategy rather, for a day trading system, then you would need to use it on a lower time frame, maybe H1 or 15 minutes. Okay, so all you want to see is, you will just want to see a fair value gap whereby the third candle of the fair value gap closes above the wick of the second candle. Okay, so this is an example that shows a set of candles that we cannot use. Okay, so we cannot use this particular one. Why? Because of course there's a fair value gap there, but you can see what happened. The third candle, sorry, this third candle right here did not close above the wick of the second candle, so this is not a good fair value gap to use. So you need to pay attention. The third candle needs to close above the second candle. Okay, it needs to close above the wick of the second candle. You can see there is a gap right here. Let me get two horizontal lines to show you the gap. So truly there's a fair value gap here. You can see that the wick of the first candle did not intersect with the wick of the second of the third candle. The wick of this candle did not intersect with the wick of this candle. So this is a valid fair value gap, but for this particular strategy we cannot use it. Why? For the simple reason that this third candle, this third bearish candle, is not close above this wick. Okay, so we are not going to be using that. We need to wait to see another fair value gap. Okay, so this is another set of candles that formed a fair value gap. First candle, second candle, third candle, and you can see the third candle closed above the level of the second candle. So this is a valid fair value gap that we can now use to trade. So there's something called consequence encroachment, okay, which implies that if a fair value gap is going to be respected and price is going to be pushed upwards, if it's a bullish fair value gap, or price is going to be pushed downwards in a bearish fair value gap, then the middle of the fair value gap must not have any candle closing below it if you're trying to buy, or above it if you're trying to sell. So that's what we're going to take advantage of. Okay, we're going to take advantage of that, and we're going to be placing our trade at the middle of the fair value gap. So you can do your calculation and place your trade at the middle of the fair value gap. You can place a pending order there. Your stop loss is going to be where? A few pips below the fair value gap. Okay, if it's not too big. All right, so if it's big, then you just have to place it at the bottom of the fair value gap. All right, so your target is going to be the external range liquidity. Okay, because you're expecting price to come back and take internal range internal liquidity, and then move out to external liquidity, which is the area you're going to be taking your profits. Okay, so you can see what happened. Price came to that middle point and then pushed to the upside. In the previous example, in the previous fair value gap that we did not use, you would notice that price came back, but it went way deeper into the FVG. Okay, it closed the gap completely, of which if you place your stop loss at this tip, it might have gotten it. Okay, so that's one of the reasons why we don't use what's it called, we don't use a set of candles that form a fair value gap whereby the third candle did not close above the second candle. The implication of the third candle not closing above the second candle, what it implies is that the momentum is on a serious pause. Okay, the bullish momentum is on a serious pause. Okay, that's the reason why that third candle did not close above it. Okay, so it implies that price could reverse completely. That's one implication. Or it could also imply that the gap will be filled completely, or it could mean that the gap will even, as in price will even go past the gap a bit to, induce people into taking sell trade, and it will now push up. So it's kind of confusing that way. So it's better for you to use a set of fair value gaps whereby the third candle closed beyond the second candle. Now, the implication of the third candle closing beyond the second candle is that the bullish momentum is still very strong. So if it's even going to retrace to the fair value gap, it won't go beyond that consequent encroachment region. So I'm just giving you the foundational ideology behind the strategy. Okay, so it played out here. Let me give you one or two more examples. So look at this. First candle of the fair value gap, first candle, second candle, and this is the third candle, and you can see the third candle closed beyond the wick of the second candle. So we simply mark out our fair value gap. Then the middle of the fair value gap is where we want to do what? Take our trade. So we have a fair value gap right there. Let me get the middle. The middle is going to be somewhere here. You can actually do an exact calculation if you want. So that's the middle right there. As you can see, right here, price did what? Price tapped into the middle. Okay, you can take your profit at external range liquidity. You can see price moved up and smashed the TP right here. Okay, price moved up and smashed the take profits. As simple as that. Okay, so basically that's what I have for you. If you have any question, you can ask in the comment section. If you're a new viewer, please subscribe to the channel and turn on the notification bell. I'll see you in the next video. Thanks for watching.